Across 11 episodes, this channel has done one thing: take strategies that look smart and show that the math refuses them. Day trading, lotteries, lifestyle inflation, concentrated portfolios. Today, we do the opposite. There is exactly one strategy the math actually supports for almost every person who is not a full-time professional, and it is the most boring sentence in finance. Buy the same dollar amount of the same index on the same schedule forever. It is so simple it sounds like a trick. The math says it is not a trick. The strategy has a name: dollar cost averaging. Benjamin Graham gave it that name in 1949 in The Intelligent Investor, the book Warren Buffett has called the best book on investing ever written. Graham described it as investing the same number of dollars in stocks each month or each quarter. Same dollars, same interval, no decision required. He recommended it for what he called the defensive investor, someone who lacked the time, the temperament, or the inclination to do real security analysis, which is to say, nearly everyone. For 75 years, the strategy has sat in plain view. Every employer-sponsored retirement plan in the developed world runs on it. Every target date fund executes it on autopilot. Every robo-advisor sells it as the default. And almost every retail investor I have ever talked to still says the same sentence to me, which is, yes, but I'm waiting for the right entry point. The right entry point is a market timing forecast. Last episode, we looked at concentration risk, betting everything on one stock. This episode is the temporal version of the same idea: concentration in time. If you put your money in at one moment, you have made a forecast about that moment. If you spread your money across many moments, you have replaced the forecast with a schedule. The forecast can be wrong, the schedule cannot. It just is. This is the only strategy in personal finance where the harder you think about it, the worse you do. The marketing for it is bad because the math for it is good. There is no story, no hero, no insight to share at dinner. There is only consistency. Today we run the math behind the consistency, the behavioral research behind the requirement for it, and the honest counter case that says it is not actually optimal in the textbook sense. It just happens to be optimal once you include the cost of being a human being. Here is the arithmetic: 2 strategies, 4 months, an asset whose price is $50 in month 1, $25 in month 2, $40 in month 3, and $50 again in month 4. In strategy A, you buy 20 shares every month, same number of shares regardless of price. In strategy B, you commit $1,000 every month, same number of dollars, different shares. Under strategy A, you spend $1,000 in month 1, $500 in month 2, $800 in month 3, $1,000 in month 4. Total $3,300. You hold 80 shares. Your average cost is $41.25 per share, exactly the arithmetic mean of the 4 prices. Under strategy B, you spend $1,000 every month, $4,000 total. In month 1, you buy 20 shares at $50. In month 2, you buy 40 shares at $25, because your fixed $1,000 goes further when prices are low. In month 3, you buy 25. In month 4, you buy 20. Total, 105 shares for $4,000. Average cost, $38.10 per share. Strategy B paid 8% less per share than strategy A. Same asset, same prices, same total dollars. The only difference, strategy B held the dollars constant. Strategy A held the shares constant. This is not a coincidence. The fixed dollar average is the harmonic mean of prices. The fixed share average is the arithmetic mean. And it is an algebraic theorem that for any set of positive numbers that are not all equal, the harmonic mean is strictly less than the arithmetic mean. Not approximately, always, which gives dollar cost averaging a structural property no other passive strategy has. It loves volatility. The bigger the dip on the way up, the larger the harmonic mean discount. A flat market gives you no DCA advantage. A perfectly rising market, counterintuitively, gives you a small disadvantage compared with a single lump sum at the start. But a real market, the kind that wiggles up over decades, the kind we actually have, hands you the discount automatically without you having to predict where the dip will land or how deep it will go. The math turns the asset's variance into your shares per dollar. Now the obvious objection: If lump sum is mathematically better in a steadily rising market, and the stock market rises steadily over long horizons, then DCA must be worse. This is not wrong, it is narrowly correct. Vanguard published a paper in 2012 titled "Dollar Cost Averaging Just Means Taking Risk Later." Their data, across 12-month periods in US, UK, and Australian markets between 1926 and 2011, lump sum beat DCA in roughly 66% of cases. The honest finance answer is that DCA is a behavioral mechanism, not a return maximization tool. If you have a lump sum sitting in cash and you can mentally tolerate deploying it tomorrow, the math says do that. Almost no one can, which brings us to the real reason DCA exists. DALBAR, a Boston research firm, has run the same study every year since the early 90s. The study compares the return of U.S. equity mutual funds against the return earned by the average investor in those same funds. The funds beat their investors year after year. The 30-year window ending 2022, the S&P returned 9.65% annualized. The average equity fund investor earned 6.81%, the same money, the same market. The investor lost 2.84 percentage points every year, not to fees, not to taxes, but to behavior. Buying after rallies, selling after dips, trying to time it. Compounded over 30 years on $10,000, that gap is the difference between $158,000 and $72,000. The investor lost more than half their potential terminal wealth because they kept making decisions. DCA is not optimal in a frictionless world. You do not live in a frictionless world. You live with your own cognitive biases, your own fear in March of 2009, your own elation in 2021, and DALBAR has 30 years of data showing what those biases cost. Once you price them in, DCA is optimal because it removes the decision. Case 1, March 24, 2020. The S&P 500 had just lost 34% in 23 trading days. The COVID panic was at maximum intensity. On March 24th, the index rose 9.4% in a single day, the largest single-day gain since 2008. That one day was the start of a rebound that took the market to new all-time highs by mid-August. The investors who had sold during the crash to wait until it stabilizes missed it. The DCA investors who kept their March deposit running bought at the absolute bottom by accident. They were not smart, they were consistent. Case 2, JP Morgan, missing the best days. JP Morgan publishes the same calculation every year in their guide to retirement. $10,000 in the S&P 500 from January 2004 to December 2023 fully invested becomes $63,637, about 9.7% annualized. The same $10,000 but missing the 10 best days of the 20-year window becomes $29,154. Less than half. Miss 20 best days and you end at $17,000. Miss 40 and you are below where you started even after 20 years. And here is the part that breaks people's brains. 7 of those 10 best days happened within 2 weeks of the 10 worst days. The recovery and the crash sit on top of each other in the calendar. If you exited the market during the crash, you almost certainly missed the recovery. Case 3, Barber and Odean, 2000. Brad Barber and Terrence Odean got access to 66,000 U.S. retail brokerage accounts from 1991 through 96 and wrote a paper titled "Trading is Hazardous to Your Wealth." The market returned roughly 18% over the period. The average household earned 16.4. The most active 20% of households earned 11.4. The most active traders underperformed the market by 6.5 percentage points every year, almost entirely because of their trading. The paper has been cited over 6,000 times and remains the empirical foundation of indexed retirement defaults. Case 4, Warren Buffett, 2017. At Berkshire Hathaway's annual meeting in May 2017, a shareholder asked him what a regular investor with no time for analysis should do. Buffett said, "The best thing to do is buy a little bit over a long time. That is the entire strategy in 12 words. Buy a little bit over a long time, don't try to be clever." A quick note, this episode is sponsored by my private community where I keep the tools and templates I use to actually run the math in this channel. DCA calculators, retirement plan models, behavior gap simulators. If you want the spreadsheets, the worksheets, and the courses behind the formulas, the link is in the description. For people who would rather build it than read about it. Now, back to the part of the strategy that is harder than the formula. So here is the structural point. Timing the market requires you to be right twice. Once when you exit, once when you re-enter, two probability gates in series. Even if you are 70% accurate on each, which no professional investor in the world is over a long horizon, your joint probability of getting both right is 49%, worse than a coin flip. And the cost of being wrong is concentrated in roughly 10 days a decade. DCA requires you to be right 0 times. You make the decision once, set up the auto deposit, and then you commit to not making any further decisions. Your edge is not in the prediction. Your edge is in the absence of prediction. The market does not have to cooperate. The strategy just has to keep running. This is why DCA looks so unimpressive in a textbook. It does not optimize anything. It does not capture inefficiencies. It does not exploit anomalies. It just sits on top of the market's natural systematic return generation and harvests it month after month. Every other strategy in personal finance is a story about how the investor adds value through skill or selection. DCA is the only one that admits the investor adds value only by staying out of the way. The math of the harmonic mean works for free in the background. Your job is to not interrupt. This is also why DCA is the implicit default of the entire pension system. Auto-enrollment in employer 401k plans pushes U.S. worker participation from 47% under opt-in to 92% under auto-enroll. The system was redesigned in 2006 precisely because the behavior of opting in was the single largest leakage in retirement saving. Removing the decision raised the participation rate by 45 percentage points. That is what removing a decision is worth. The thing the math does not solve for you is what to do during a crash. In March of 2009, after the S&P had fallen 55% from peak, your auto deposit was still scheduled. The same $500 was about to go into a market that had just halved. The strategy said, keep buying. Your gut said, stop. The 30-year DALBAR gap exists almost entirely because of what investors actually did at moments like that. The strategy works only if you keep showing up at moments when every part of your brain is telling you not to. DCA is not difficult mathematically, it is difficult emotionally. The math is two-line algebra a 14-year-old can verify. The discipline to keep depositing in March of 2009, in September of 2008, in February of 2020, in October of 2022. That discipline is the hard part of the entire strategy. The arithmetic does its work only if the deposit happens. And the deposit happens only if the investor does not panic. So the question this episode hands you is the same question the next episode will start with. Why do we sell at the bottom? What is happening in the human brain that makes the moment of maximum mathematical opportunity feel like the moment of maximum danger? So we close on the strategy that has no story, no founder, no breakthrough moment, no contrarian insight. Benjamin Graham described it in 2 paragraphs in 1949, and the strategy has not been improved in 75 years. It does not need to be. It works because of the harmonic mean, which is older than algebra, and because of the behavior gap, which is older than the stock market itself. If you take only one sentence from this entire channel, take this one. The investor who shows up every month in a low-cost, diversified index fund doing nothing else beats almost everyone who tries to be clever, including most professionals, over a 30-year horizon. The math does not require you to be smart. It requires you to be present. 10 episodes behind us: compound, decay, variance, zero, multiplier, weapon, creep, 2 tags, diversification, and now consistency. Same math, 10 costumes. Next episode, we look at the other side of consistency, what breaks it, the psychology of selling at the bottom. Why every investor knows the rule and almost every investor breaks it at the worst possible time. Until then.